Hi, my name is Nick Sutton. I'm a CPA. I've been practicing public accounting and taxpayer representation since 1998. I am co-founder of Tax Matters Solutions. Today, I want to talk to you about installment agreements with the IRS. An installment agreement is an arrangement granted by the IRS in which the outstanding tax debt can be paid over a period of 5 years in monthly installments, plus adding in penalties and interest. Eligibility for an installment agreement is based on the taxpayer's financial circumstances and their ability to repay. There are, in essence, 3 different types of installment agreements. The first one that I'd like to talk to you about we'll call streamline, and this is where the amount that you owe is less than $25,000, and you have the ability to repay this within 60 months. So, here for our example, let's just go ahead and calculate. Let's assume that we have a $15,000 liability divided by 60 months. Would be $250. That would be our monthly payment. And then we also need to add in a component for interest and penalties, and that would be basically the payment that we'd be looking at for the IRS. The streamlined installment agreements are statutorily provided to you by the IRS. The next type of installment agreement, for lack of better words, we'll call complex. And this is where the amount that we owe is above $25,000, or our ability to repay cannot be accomplished within 60 months. A complex installment agreement is basically calculated by taking your monthly income minus your monthly allowable expenses, which will equal your monthly disposable income. The IRS will tell you that your monthly disposable income would equal your payment. Well, this is where, once again, the devil lies in the details, and where a taxpayer representative may very well be able to help you come up with a lower payment. So let's look at a complex payment plan. And let's say in this example, we owe $35,000, and we're going to repay this over 60 months. We're looking at about a $583 payment. Once again, we need to add in a component for penalties and interest. The third type of payment plan would be a partial pay installment agreement, often referred to as a PPIA. To understand the partial pay installment agreement, you really need to understand another item, and that is the collection statute expiration date. The collection statute expiration date is the time period in which the IRS has to collect that tax debt against you. The collection statute expiration date can be a much more complicated issue, but here for our discussion, let's just leave it as the 10-year period in which the IRS has to collect. So the partial pay installment agreement may be a viable option when your monthly disposable income will not full pay the amount you owe within the collection statute expiration date. The documents that you're going to require to need are going to be the following. You're going to need 3 months of documentation to substantiate your income and expenses. Examples of these would be 3 months worth of bank statements, 3 months worth of mortgage statements, 3 months worth of pay stubs, so on and so forth. The other forms that you'll need from the IRS would be a 433A or a 433B. This is called a collection information statement. The 433A is done for individuals, and the 433B is done for self-employed individuals. You will also may need a 433F if you're working out your payment plan with ACS, Automated Collection Services, directly. More than likely, they'll be referring to a 433F. You'll also need to complete a 9465, that is Form 9465, which is the request for your installment agreement. As I'm sure by now you have many questions and may be confused about installment agreements with the IRS, please feel free to give us a call and we'd be happy to walk through your options as far as the installment plan with the IRS. I would recommend hiring a professional or a representative to ensure that you not only get a payment plan with the IRS, but also a payment plan in which you can afford.